So today we are going to continue with the ratio analysis topic. We stop on profitability ratios. So what is the profitability ratio? It measures the company's ability to earn the profits. We have a few types of profitability ratios. Let's see them. First is the gross profit rate. It indicates how well net sales cover the administrative and selling expenses, which means that it is simple already the explanation given. That means how your sales, your revenue cover your administrative and selling expenses which you have done on the business. So the formula is following. So you have to take your gross profit, which you can get from income statement, right? And divide on net sales. The net sales, this is as well we can get from income statement, that the top of item of income statement, and multiply on 100% because we are going to see in the percentage. Let's see the calculation. Here is gross profit is equal to 48,500 and the net sales is 99,000. And we have got the result 49%. That means our sales that we are receiving, the revenue, they cover administrative and selling expenses by 49%. Or we can say that our administrative and selling expenses takes around 49% of all the net sales that we have generated during the financial period. Okay. So next rate is return on sales. So it shows the relationship of the net income before tax and net sales. So it indicates as well the effectiveness of the company's pricing policy. That means how the company fixed its price, how effective price being fixed by the company to cover all its costs. So here is, we have to take our net income before taxes, which we can get from our income statement, and divide on net sales. Right, so as well, if you would like to see the percentage, just multiply on the 100%. So calculation following, and the results we have got 13.5%. That means our net income, which is before taxes, we have 13.5% of a part of inside of net sales, that we can generate net income from the sales by the 13.5%. That means. So I have a question how we could find the net sales. The net sales you would find from income statement. You see, in the income statement, some companies the sales products on credit, or by cash, or by prepayments. So here is you would find the item which can be called revenue or sales on credit, or just net sales, which is the same as the sales one. So you won't be confused if you put your sales as net sale. That is the same thing that you would find. I won't give you some income statement which would be included, which sales were done by the different payments. But most of the company, they prefer to use one or two types only. Just sales by cash could be, or prepayments, or on credit. Next one, we have rate which is called the rate of return on total assets. So it measures how wisely the company has invested in and managed its assets. So we have two ways to compute this ratio, which means we have two kinds of formula you can use to find your rate of return on total assets. First is you have to take your net income before interest and taxes and divide on your total assets. In the percentage, if you would like to see, you just multiply on 100%. And another formula, the second formula for rate of return on total assets, you have to take your return on sales, which the formula we have done previously in the previous slides, and multiply on total assets turnover. That total assets turnover, we have as well this formula done previously, right? So it depends how is more easily for you which formula to follow. For me, the best formula if you would follow the first one. Take your net income before interest and tax from income statement and divide on total assets from which is can be get from the balance sheet. So I have a question that what that means, the net income before interest and taxes. This item, you remember we have done the preparation of income statement. This is item net income before interest taxes comes after all deduction of expenses, which is cost of goods sold, the administrative expenses, the operating expenses. And then we have a net income before interest and taxes. After that, the items comes which would be the taxes charges and interest expenses. After deduction of taxes charges and interest expense, you will get the net income after interest and taxes. That would be the net income whole. That's why. So this rate, which is the rate of return on total assets, shows us how efficiently we use our assets. How did we invest in? How do we have any kind of effective projects? How projects or investment projects, our investment projects are being effective and efficiently in usage. This rate shows the picture of effectiveness of your projects. Next one, we have a rate of return on total assets. This is here is I think the calculation comes the same formula before. So here is after calculations we have results which is equal to around 41%. That means we generate our net income from the assets by the 41% is being used. Mostly is the 50% can say that our assets have been used effectively and efficiently to get profits. So the higher the results we have at the end of this calculation, the better it's for company. That is, usage its assets very efficiently in effective manner. Next one, we call the rate of return on common stockholders' equity. The stockholders, or we can say the shareholders' equity. So the return rate on equity, let's say. So it indicates how well company is managing the debt financing to earn profit for holders of common stock. So that means how efficiently we use our equity, which is the main our own capital. Here is we should get the net income before taxes and minus the preferred dividends must be deducted if we have a preferred dividends. If you don't have a preferred dividends, though, you just must ignore it. And divide on common stockholders' equity and multiply on 100% if you would like to see the percentage. Let's see the calculation. So we have, as a result, we have 66.3%. That means we have generated the net income before taxes of 66% from our usage of equity. You see, this means that you have used your equity, how efficiently you can use it. That means you have used your equity by the 66% of total amount that you have in your accounts to generate your incomes, to generate your profits. So the higher this percentage is better. That means you're managing your company, you're running the business at the efficiency way because you're using your the capital, the whole amounts that you have it. But because in the management, when we manage our finance, the important question, how and what way you can manage your assets and as well your capital that you have. So the best way, if you have the higher result, that means you really use your equity, which means your own capital, at the whole amount to generate the profits. Okay, let me see. I have some questions on charts. Just see. So the question is that how we could, for example, you're asking me when it will be efficiently, like how we could recognize that we're using our assets or equity efficiently, right? We have the market trends and as well the norms where we can do comparison and see how we did really use our equity and our assets. You remember we have talked about that we have some standards, some norms, but norms all depends on industry, in which kind of industry you have your business or the market, and as well the size of your company, as well the location of your company. By geographically we can measure it. So this is all comes with a comparison, because this is all the analysis that we have done, horizontal, vertical analysis, and the ratio analysis, we do in comparison with the rest of companies, the same industries, or we can do even just to compare with our previously statements which we have done. I mean, we can get the statistical data at least for past 5 or 10 years and to see our development in the businesses, as well the efficiency management of finance, how we have done the management based on our finance. So this depends. It depends on the company's industry as well. This is always about the comparison. So we have no special like standards and rules. That the results must be no less than the 60%, for example, or something else. I mean that you could use your equity, but always comes with a comparison with the same size of companies at the same industries, maybe same locations, so we can see. Okay, next move. So that's all what we have done based on the ratios. We have done the most, which is the common, and the important ratios we use in ratio analysis. And right now, I have a summary of all the financial performance metrics, which is the same as the ratios. Here is you would face the sum ratios which we have done already in the class, and some of them are new ones. Let's see. The first one, liquidity ratio. Remember, we have done the current ratio and the quick ratio. And here is given to you the calculation, which means the formula shows you, and the strength, which means what the result should be at which level, the higher or lower. So, for example, the current ratio must be the higher results you have. That is the better for the company. Next one is the quick ratio that we have done. Is as same as the acid test ratio. We have two names of this ratio: quick ratio or acid test ratio. You can find. So the higher these rates are, is the better for the company. Next one, we have some net working capital ratio. So I didn't give this ratio in the slides, but here is you can see the formula. So you have to take your current assets, your current liabilities, and deduct from the current assets. So the higher is the results, is the better results for the company. As well, we have a cash ratio. You see, if you would like to see how we would use our cash, how efficiently we use our cash, and what's the let's say the certain amounts of cash we have in all our assets, and how we can cover our liabilities, the current liabilities, by the cash. So just get your cash and divide on current liabilities. The higher it means is the better results. Next one, we have some activity. Asset management, same as asset management ratios. We call it the total assets turnover, the fixed assets turnover, we have it, the capital turnover, the accounts receivable turnover, that formulas we have done, accounts receivable days outstanding as well, inventory turnover we have done, and inventory days outstanding. So here is you can see the formulas is simple. All the items can be get from income statement and the balance sheet. And based on these, here is you can see the trends, which is the higher results or lower results is the better results for the company. Okay, let me see. I have some chance about the breaks. So, okay, let me continue, and you let me know if you need the break for prayer. It's okay for me. Okay, if you need the break for prayer right now, we can do it right now. Are you agree, all of you? Okay, good. So for 5 minutes, right? Or after 5 minutes? I'm sorry, you are all from different cities, and some of you are asking me to have a break after 5 minutes. Some of from after 10. Okay, after 5 minutes is now is 4 o'clock 23 minutes. At 28 we would have a break for 5 minutes. Let me finish this the summary, the list of metrics. And we have some leverage, which is debt management as well. You can face you can face the name of debt management ratios as the leverage ratios. So here is debt to equity ratios, we have done it as well. The financial leverage, you have take your all assets and divide on equity. So here is the lower is we have a lower the results is the better for the company. Let's see the next one. We have here is so, and this is the second page of the list of ratios, and that's all for the ratios for. And here is capitalization ratio. The lower is the better results. And interest coverage, earnings before interest and tax, and divide on interest expenses. So the higher is the better results. We have some profitability ratios that we have done, which is the net margin, pre-tax margin, operation margin, gross margin, as well as return on assets, return on net assets as well, return on capital, and return on equity. We have done all these formulas. Some of them are a new one, but it's would be easy to read if you can see the formulas. That all items can be getting from your income statement balance sheet. So here is for profitability ratios. The the most important in the profitability ratios, the things that the higher results you have is the better. You see, for all the profit ratio, because that means how efficiently we use our assets and our equity and the capital. So, and it's all results of our sales, of our revenue. And as well, we have some market ratios. And this is the market ratios are a new one, because I did give in the slides before it. But you can see here is the formula. So let me show you. This is so I just okay. Here is price earnings ratio. So and here is we have to get your stock price per share. You would find in your income statement, or you can do calculation by yourself, and divide on earnings per share. That if you have your earnings, actually, this all depends on if you have a earnings. If the company have a loss, then no kind of earnings you would find. You won't find the price earnings ratio. Market to book ratio, the market value, and divide on the book value. The shareholders returns here is as well. You have to get your capital appreciation plus dividends and divide on your beginning stock prices. And dividend yield is a dividend per share and divide on beginning price. So all the results must be higher. The higher is you have results on market, that is the better. That means your stocks or your shares been valued at the higher prices. As well, your company means to have a value on the market. So we actually, at the financial management, at our practice says we won't use the market ratios, but the companies which is, let's say, the medium or which is huge, the corporations, they use these formulas by market ratios to really identify the value of their shares, the value of the company, the value of the company. So we have done the list of ratios before moving on benchmarks that we can see. We can do a break, right, for 5 minutes. So okay, thanks for your attention. Let's do the break for 5 minutes or for 10 minutes. Some of you asked me for 10 minutes. Okay, if we do for 10 minutes, then our class would be extended for 10 minutes or more than it. Is it okay for you? I think, hope so. Okay, 10 minutes break. So we have completed our ratios, have seen all the types of ratios we have. And the previously slides, which is given to the summary of list of all ratios, we have based on the formulas and the strong sheet. You can print these 2 pages, the summary of financial metrics. You can print these pages because that would help you in the future to make any calculation. That would be always available. And as well, you will have on the exams, there's some practical exercise based on ratios. So you can use the list. So now we are going to move and look at the industry benchmarks. So the question I had before, that how we could recognize that we have been managing our finance, our company efficiently. So first of all, we do it in comparison with the rest of the companies that we have in the markets. So we have some benchmarks, which is the benchmarks, which means the company's benchmark, which is the best or leading the companies. They post their results in them online on internet. So or some journals or financial magazines you can find. So you can get the results and to compare with yours. But it all depends on industry. You have your business, you have your own companies, run your or work at that company. Let's see. At this page we have a food service and drinking place. So I just giving you one example only. At internet you can find a lot of different examples on based on different industries. If you're interested in, for example, financial banking industry, you can find the benchmarks. This, which can say the market trends of the ratios in, on that special kind of industry. And here is we have a food service and drinking places, and giving you the corporation annual average sales, income, and expenses. The annual, which means the year, based on the yearly results. For example, here is given just a market trends, or as the benchmark being norms, we can see and make comparison with our company. If your company is a food service or some drinking place, like restaurants, like coffees, or some that which is providing service for food or drinking. You know, the bars, maybe what pubs, like, or that if you have in your country. Okay, let's see. As this is based on income statement, our benchmarks results here is given the it shows how the results of income statement based on, I have seen the vertical analysis. You remember to see the percentage of the total base. For example, the sales has come by the 100% of the sales, and we can see all what the kind of different expenses has been taken from all the sales. Like cost of goods sales takes around 43% of all the sales. This is for all of kind of food service and drinking places, and this is given you by International on 2008. But today, now is it 2013, so the results can be changed, right? This is old information I'm giving you because I haven't found the new ones. Okay, next one, the gross profit. Okay, the cost of goods sales. We have 43% of total sales. I'm sorry. Some of you say that you cannot hear. You can't hear me. Oh my gosh, what has happened? Okay. So next one, for example, as like administrative expense, like salaries and wages, is takes around 18% from all sales. The rent, we can see the 7%. The taxes is 3.7%. What interest paid is around 1.7%. Okay, and let me. Okay, I'm sorry that some of you say that you didn't hear the beginning of the slides. That's so terrible. So we'll start again. So here is when you do calculation based on your ratio analysis, you will get any kind of results, right? Based on your ratios, and to recognize, to identify, to indicate what the results means, how we could understand that we do manage our business in an efficiency way or effectively manage our assets. We can make a comparison with the leading companies, for example. We call it the benchmarks. And here is I giving you the example, just example, one example based on the food and service and drinking places by the 2008. And this is a industrial income and expense statements, and we can see by the vertical analysis what the percentage of each items of each expenses is being taken in the certain base of sales. Based on the vertical analysis, sales must be equal to 100%. We do it as a 100% as a whole certain base. Then we can see the each items. We can make the calculations and to find the percentage of each item in the sales. And based on the benchmark, which is can say market trends, we can see that the cost of sales takes a 43% from the sales is for all of different kind of food service and drinking places. It's like, as I told you, the restaurants, the food services, right? The cafes, what else is some bars or pubs, all the services which provide the food and some drinking. So this is for all this kind of industry. Next one, we can see that salary and wages expenses that we pay for our staff, that takes around 18% of whole sales. And for each item, you can see how many percentage it takes in the sales. How many percentage of expenses takes from being taken from the sales one. Here is we can see the advertising is around 2.26%. Have expenses, and which is a very the advertising expense as well is the most important expenses. It takes huge amounts. And benefits and pensions, for example, that we pay for our staff is around 1.71%. Other kind of expenses, like administrative expenses, they take around 16.26. So from here, and we can see that the net profit actually being negative. Can you see that is being negative? Minus 0.13% off. So this is, you can assume that if your net profit is being positive, that you can do comparison with this kind of benchmark companies, and can conclude that your company is running the business not bad, that managing finance to right and efficiency way. And as well, we can make conclusion that can you see what kind of expenses takes a big place in our sales that we generate. The first of all is, of course, this is the cost of goods sales, right? This is raw material, the salaries we pay for staff in the production process, right? Is around 43%. Next one, the salaries and the wages, which is 18.33%, that we pay for our staff. This is, you see, the two items which is being taking big place in all of our expenses and in the organization of food or service or drinking places that we have. Let's see the next one. I have another example. So here is same the food and service drinking places, and the report based on the balance sheet. As well, we can see based on vertical analysis, like the certain base we are taking the total assets, making the 100%, and the total liabilities and equity as 100% as well. And you can as well make comparison and see the difference, what kind of assets is being taken on a big place in the total assets, or what kind of liabilities is being taken big places. For example, in this example, we have in our liabilities, the big place takes like accounts payable. You see, is 8.64%, and some kind of other long-term liabilities is a 41%. So this is the company. Around 50% is taken, the money is taken, is owed actually by the company. And what about the equity? The equity, the net worth, here is the net worth. The equity is around 39%. So this is based on the benchmarks companies. So this is based on this is been given you benchmarks as an example for the food service and drinking places based on the balance sheet report, and we can do our comparison of the comparison of our financial statement with these benchmarks. But this is only for it's an old one, so for 2008. If you can find in internet for the last years, which is in euros, that would be a good one. So you can share with us so we can see the differences. Next one, let's see the ratios, the industry financial ratios, as well as have some, which is the report of the benchmark companies on the food service and drinking places. So I'm giving to you only this example. I have given to you source. Here is bstart.com, where you can find the examples on different industries. So you can go for this website and do find the examples of benchmarks on different industries, on different size of companies, or geographically could be spanned, and as well by the markets. So this is based on ratios. Here is we can see return on sales on the based on benchmark is given a negative 0.13% of ratios. Return on assets, return on net worth. This net worth means equity. Okay, this is stockholders' equity or shareholders' capital. Sometimes you can say the word net worth. Quick ratio, you can see quick ratio is around 60%. The current ratio is 85%. That means, for example, at the current ratio, what that means 85%? That means based on the benchmark companies of food services, we have our current assets and we can cover our liabilities only by 85%. You see, and if your results at the same industries is being higher, then that means that you can assume that your company is managing your current assets at the right way. So inventory turnover, here is we can see asset sales and total liabilities, which is net worth, is the equity, total liabilities to equity. So how much total liabilities we have in our total equity. So this is here is example based on food services. So, okay, let me see your questions. Okay, about net worth. Net worth is same as equity. So, of course, that in some reports giving you the word which calls equity, the stockholders' equity, in some of shareholders' capital, or you can see the net worth. That could be that the names of these, the equity or capital, would be different one at different reports. That depends on the company, how they would post their financial reports, what kind of word they use. But it's all you have to you won't be confused. You have to think that it's the same meanings of these words. And I cannot give you that the statement with exactly one kind of names of the items, because at the future you can face a different kind of statements where you can see the net the word for equity like a net worth. You have to recognize that it's the same as the equity and the same as the capital. So, and this is depends on companies how they would call the capital or equity different words. This is not depend on me. So that's why examples given to you different names of items. But most of them are already, and I'm giving you the examples as well. Let's see the next one. So right now we have a quick review questions. This says at the homework assignment number 8, but we are going to solve this exercise on the class right now. You have a time, because later I will give you a new one exercise which would be similar for this, and then you can do practice by your own. Okay? So let me see what the questions we have. So some of questions is about equity, net worth. This is I have explained you already. So let me see the questions. What about you? So okay, Miss Lida asking me why I'm ignoring the gross profit, or what is amortization and depreciation items. For sorry, Miss Lida, for what kind of reports you are asking? So because the examples given to you previously, this is example where the benchmark companies post in the online, and if they post without amortization depreciation item, then this is like what we can see. If you can find a different kind of samples which would be include all detailed items in the financial report, then that's good. So you can share with us. But based on my examples, if you go for this website, you can see the financial reports of different industries, and you can see the benchmarks of different industries and do comparison with your ratios and your financial reports. This is how the company is done. But this is actually this all reports done by the research organizations. We have like consultation companies or research corporation organizations. They do provide this kind of benchmark reports for all of us at free of charge. And of course, it is sometimes difficult to get this information because it can be at charges. And actually, if your company, like some corporation or huge company, wants to have wants to get the benchmarks of the financial reports at the specific industry at a specific date, I mean, which would be the latest years, then they would request to get this information from research organizations. And these research organizations, they do their job, of course, based on the payments. This is not at the free of charges. But that's what I would find on the free on the internet. Okay. So, and for example, based on Miss Lida's question about depreciation, she asked me why we can't find in the balance sheet the depreciation items. Here is given to just fixed assets, right? because this is fixed assets is here is equal to 0 percentage, and I haven't given you the depreciation percentage. How much is actually is already after deduction of the given to after deduction or without any deduction. We cannot show and guess how they done their reports. Okay, let's continue with quick review question with the practical exercise on the class. This is a practical exercise based on the ratio analysis. The question. So, given to your assignment, the harvester company sells spare parts for agricultural machinery. His financial statement for the years above been summarized below. So, here is given us the income statement for the years year 6, year 7, year 8, for 3 years. And we can see we have a sales on credit. You see, this is same as the sales or sales on credit or net sales. Okay, the sales on credit we have for year 6 is 800, for year 7 is 1,260, and for year 8, 1,714. Last, we have a cost of goods sold. Inside of cost of goods sold is including the opening stock. What is stock? You remember this is same as inventory, right? We have opening inventory. Opening means beginning the inventory at the beginning of year. At the 6th year we have a 40. At the 7th year we have a 50. Here is the 7th year. This is little bit comes lower. I don't know. It's the example like this. At the year 8, it's the open stock is 100. Next, we have a purchases, right? We have purchased some goods. At the year 6, we have 650. Year 7, 1,100, and year 8, 1,680. Next, we have some closing stock. Closing stock that means the inventory at the ending of the year. So the year 6 comes with a negative figure, minus 50. And the year 7 comes with as well as a negative figure 100, minus 100. And at the year 8 comes 200 with a negative figure minus 200. So and gross profit as well, we have a gross profit for year 6 is 160, for year 7 210, and year 8 260. As you can see, the gross profit is being increasing year by year, right? If you do comparison just in the years, among the years. So we have left the other kind of expenses like loan interest. Loan, this is the credit, right? So that's how we pay some expenses for interest. And the year 6 is the negative comes 80. Because the negative might be deducted, so 80, year 700, and the year 8 is 120. Yes. And we have some loan interest. The year 6 we have no any kind of loan interest. Year 7 same. At the year 8 we have a 20. So all our other kind of expenses are total at the year 8 is as a negative figure 140. And we have a net profit. We can say the net profit for the year 6 is the 80, for the year 7 110, and year 8 120, right? So this is clear, right? The income statement, very simple one, which is with the clear items and figures. Let's see. We have the balance sheet for the same Hessler company. We have in the balance sheet the items like a capital, the profit, less drawings, some loans, which is repayable in 5 years, current liabilities, creditor, bank, fixed assets, the current assets, which is stock, debtors, and bank. So, for example, the balance sheet for year 6 is being for our liability in right? And for year 7 is being the total assets 506, and for year for the liabilities and equity, the year 7 is 506. And for the year 8, is liability and equity is equal to the balance equal to 882, and our total assets is it's not 680, it must be 882. Here is just mistakes on my example, because this is made by picture, and so I couldn't change it because of 202 fixed assets of plus our current liabilities, which is 200 and 480. The total will be same as we have liabilities and equity, 882. Just please change here is amount. If I could change my own, let me see if I can do so. Here is must be 882. Oh. Because this is this is just some 882, okay? If you do ignore it, that would be great. So this is like this 882. So right now, let's see our assignment. What we have to done with these our statements. So required they calculate the following ratios in respect for each year for 3 years, year 6, 7, and 8. And first rate is the gross profit percentage on sales. Then net profit percentage on sales, rate of stock turnover or inventory turnover in the days you have to find the return on capital employed, current ratio, quick ratio, which is asset ratio, and debt closing period in days based on the closing debtor. So we have to make calculation based on all of these base rates. So let's do the calculations. Okay, are you okay with that? We can do calculations and to find all the results of our ratios based on these statements. So I have prepared you the presentation already with solutions. Okay, here is this is the same exercise. Okay, have you seen? Okay, I have changed here. Have you seen it? I have to do a change in my presentation based on exercise. So first question, we have to find the gross profit on sales in the percentage. Let's see. I'm giving you solution with a little explanation of each ratios. That would be additional information for your study. Okay. What is the gross profit percentage on sales? We call it gross margin. It develops a profitability relationship between the gross income and the sales. Where is the gross income or profit is equal to sales minus the cost of goods sold, right? Then we can get the gross profit. This is the sales and cost of goods sold. The items comes in the income statement. So gross income or gross profit. So sometimes you would find two meanings of this ratio: gross income or gross profit. So you won't be confused that it's the same things. So it represents the profitability for making a product. How actually the company is profitable at making a product, at making a business, like selling the goods or providing the services. So, and cost of goods sold, it encompasses the total cost of production. So you know that what we include in the cost of goods sold. This is the raw materials, direct labor payments, some plant overhead, and so on. So the question main for this ratio, we do identify how profitable actually is the company. You see, this is an item which this ratio is gives the answer for the main question: how profitable our company, how profitable our business. Let's see the solution. Here is I have done calculations for your considerations. Let's see. So gross margin or gross profit formula based on our previous topics is you have to take your gross profit divide on the sales. So for the each year I have done calculations, and you can see that the gross profit for the year 6 is being 160, right? And you have to divide on your sales, which in the year 6 is the 800, and multiply on 100%. You would find that the results will be equal to 20%. What that means? That means this in harvester case, in harvester company, for the year 6, it made more than 20 cents for every dollar of sales for its products. Next one, for the year 7, after calculation, you have got results 16.6%. But for the year 7, the company made more than 16 of cents for every dollar of sales for its products. You see? That means how profitable is company? How many profit company made from its sales? And for the year 8 is around 15%. We have results of our gross margins, and that means that for the year 8, the company made more than 15 cents for every dollar of sales for its products. So that we can conclude that at the year 8, company made 15 cents of each of dollar, which means the profit 15 cents of each of dollar they made sales. You see how profitable is company. And to make a conclusion based on the gross profit gross margin ratio, we can see that our profit actually is being decreased from year 6 to year 8. Have you seen? We can see the decrease of profit, because in the year 6 it was 20% of profit we have made from the sales, but at the year 8 is almost 15%. So the management body can make conclusion that our profit is been decreasing, and the question is why, right? We have to, and as you are the futures managers, financial managers, you have to find the answer for this question. Why our actual profit has been decreasing? What kind of expenses, or what actually is affecting our profits? We have some external factors or some internal factors as well. You know, external factors could be can be the market, right? The market, or the financial crisis or market trends been changed, or our competitors been strengths that they have taken, they acquired most of our customers. A lot of reasons we can find for these results, and we have to identify what is being affected, what actually is being affected. As well, it can be some internal factors. What do you think? You have to make analysis based on these figures. You see, as you are financial managers, as you actually been going to manage your business or your own business, or actually being top manager in the huge corporation, you have to make analysis based just on the figures. Why the situation has been happening like this? What affects our profits? If it's some external factors or maybe internal factors, maybe our expenses, which is cost of goods sold expenses, being increased. Like, for example, why? If we are a production company, maybe raw materials, the price for more raw material has been increased in the market. Then, of course, our profits would be decreased, right? It would affect our profits. What kind of, another kind of situation could be? Maybe staff. What about the staff? Maybe that we have increased the salary for our staff, or what else? So, or the management, the effectiveness of management is being low, and this is affect our profits. So, you see, we can assume different of reasons of been getting this result, decrease of profits. And as we are financial manager, we have to find the answer why it happens, what the reason being affected, the factors that affect our profits, and then make corrections and make adjustments for our management. Okay, this is, of course, I can see the example. The price could be low for products, but if we can compare the price for in the market with the other companies, with our competitors, if the price is the same as with a different company, let's see, with our competitors, so we have the same price, or we might have a lower price compared to the competitors. What then? This won't be a reason, right? Then we have to ignore this. Then we have to ignore the price. So maybe we have to focus on our expenses. Do our expenses being taken large and being increased during these 2 years? And as well, like the external factor can affect our profits. For example, financial crisis. Yes, you know, this is all being affected by the financial crisis, all of industries. This is so difficult to force for these changes, or some political or economical changes in the country. Do you agree? They can affect the price or the profits of the companies. So we can have a lot of discussion about the matter of our profits and the matter of our decreasing profits. But the management of finance and the efficiency of our management depends on how we make analysis and how we could find the answers and make responsible corrections on it. Okay, this is all about the gross profit margin. Let's move. Did you understand why how we did find the results, and why it's important for us to make an analysis based on our financial statements? I hope you do so. Next one, based on assignment, we have to find the net profit or net income percentage on sales. The formula is given here. The formula also given in the previous presentation. You have it. The net profit divided on the sales and multiply on 100%. For the year 6, we have a result is a 10%. What that means? For every $1 of sales, harvester generated 10 cents of net profit, which is profit after paying all its operating expenses, interest, and taxes. Okay? At the year 7, we have results after calculation 8.7%. That means for every $1 of sales, the harvester generated is lesser than 10 cents of net profit income. Can you see it? 0.087 of net profit. At the 8th year, it comes the results with 6.9%. And as well, in the gross profit, we can see here is the decreasing of the profits. Have you seen? The same, right? Situation. And there is 2 ways to improve your net margin. So we have 2 ways to improve our net margin, our net income, actually our income, our profit. How we can do it? Most of management, the literature on management and finance, they give you the examples. Like first of all is to reduce your expenses. And next one, the way is increase your prices. Or you can do in combination too. Or you can find a different solution, some creative solution. For example, what about the marketing? To develop your marketing activities. to sell more, that means to acquire the new customers. Okay, if you like to increase your profits, to acquire your new customers, and to for example, to retain the existing. This is as well important for the companies. So in this situation, based on your, I think you have a strategy management major. So there you have been taught a lot of stuff about strategy. So you could find your own strategy for your own situation. Which strategy you can use? Reducing the expenses, increasing the price, or developing your staff, or developing your marketing research. Or that depends on the company. Or I can just in combination of that, different kind of strategies. So, and based on this slide, I'd like to say that the financial management is very closely measured for your strategy management, because you can combine this, you can use your strategies, and you can use your strategies and applying your financial management, right? So if you have starting right now your strategy management manager, you can go back and review all the strategies which can affect the profits and apply in your financial management. You see? So, and as well, I would like to include some things that when we do the calculation based on ratio analysis, here is, I can show you the calculations. As well, we have to make analysis, make conclusion by our words and thoughts, by your minds and thoughts. What is being affected, how we could improve the situation, and so on. And maybe I would give you some question based on it in your exam questions, that you have to write me some theory answers for theory questions. But yeah, that's like, let's move for the next one. Next, ratio by the same is given rate of stock turnover or inventory turnover in the days you have to find. So it measures how fast the stock or inventory is moving through the firm and generating the sales that we know already from the previous slides. It helps to maintain a proper amount of stock to fulfill the requirements of the concerns, and as well to a proper inventory turnover, make the business to earn a reasonable margin of profit. So that means how you do manage your inventory in the company is very important, because it helps to generate your profits, to manage your the management of inventories helps you to generate more profits and get some as well the incomes, right? This is all together is have a linkage. Let's see formulas. Okay, some of you asked me the question, what is the gross margin, net margin, the difference, you mean that, right? So you remember, based on the income statement, we have a gross margin or gross profit. The gross profit formula, the following I have given you already. The sales minus cost of goods sold. And let me type for you. Cost of goods sold. That the cost made during the production. Yes, the cost of goods sold. This is all cost which made during the production, which is the goods or services might be gross profit. Let me. So here is. And what about the net profit? This, net profit or net margin, this is sales minus cost of goods sold, and as well you have to deduct all the expenses, which administrative and operating expenses. Okay. So calculation of our rate of stock inventory turnover or stock turnover. We can make calculation, and we are going to use here is three kind of formulas. So first formula. So to find the inventory days outstanding, which is the rate of inventory turnover, you have to take your 365 days divided on the inventory turnover. This is we are going to find the inventory days outstanding because of here is the assignment said that we request that we have to find the turnover in the days. Here is in the days. We use the next formula 365 days and divide on the inventory turnover. But inventory turnover we have to find first of all. Based on the next formula number 2. You have as well in your previous slides. So take your cost of goods sold from income statement and divide on your average inventory or just inventory. If you have no inventory at the beginning and the ending of the year, just you have an item which called inventory or stock, you have to take this item. But if you have your inventory which calls opening stock and closing stock, or inventory at the beginning of the year and at the ending of the year, we must get the average inventory. And to find the average inventory, we use the following formula number 3. Take your open stock and add to closing stock and divide on 2. This is the formula which you can find any kind of average amount for any items, right? 1 plus 2 and divide on 2. You just make summary of 2 items and divide on 2. Or you have a 3 items, just get your 3 items, the amount of 3 items and divide on 3. This is how we do find the average amount for any kind of things. This is in the math you must be done at the schools. But anyway, here is I was giving you that helps you to understand more clear. So let's see the calculations for stock turnover rate. So I have done calculations. So I have done first use the formula 2 and formula 1. Okay, I'm going to. You can see the results by your own. The calculation, I mean, because all the calculation based on the formula. It's nothing new one. And the results we have for year 6. We have 17 days, which means every 17 days, our vessel sells its entire inventory in the year 6. So that means every 17 days, the company sells its inventory. You see, 17 days. At the year 7, the results come to 26 days. Every 26 days, our vessel sells its inventory. And the year 8, the results is 37 days. That means every 37 days, the company sells its inventory. So as you can see, here is the stock turnover rate. The strength, the results must be the lower results we have is the best one. Here is at the years, but during the 3 years we have some increases in the results, right? That means our inventories over the years is being exist at our stocks. That is not good for the company. So have you seen that the shorter, the faster you can sell your product, that is good for company, right? But here is our days outstanding of inventories is being increasing by the years. Have you seen it? From like in the year 6 it's been 17 days, but at the year 8 it's been more than 2 times days being outstanding. I mean the inventory has been outstanding in our shelves, in our stocks. So what kind of conclusion you can do based on these results? Any suggestions, any recommendations? When, let me say, when your inventory is outstanding a long time in your shelves or your stocks, that could affect your profits, right? That means that the production is being decreased. That means the customers buy lesser your products or use your services. So, and this is the answer for the question why our inventories outstanding days is being increasing over the years. And as well as you can see, this turnover, the inventory turnover, our actual inventory is affecting our profits. You remember our profits was decreasing over the years, and this could be the one of reason why our profits is being decreased by the 3 years, because we cannot sell our products. Our products is being stands at our shelves or in our stocks or our shops or wherever. Our products, which could be goods or services. You see, that means our sales is being decreased by the years. But here is the interesting things. Even if your sales are actually increasing by the years, but your inventory can be outstands by the years as well. You see, here is two kind of situations. That you are trying to produce more goods, more services, but you cannot sell it. So you have increased your production during the years, but you haven't sold these products. So because you're like keeping inventories at the stocks. This is all, of course, this is the best main question for our marketing department, right? As we are financial managers, can do analysis and can make a conclusion based on these rates. We can ask the questions for our marketing department. Why our actual inventories been outstanding? Why we cannot sell our products? And or why the production is the sale of product is being so low, or so let's say. Okay, I forgot what I want to say. It's okay. So you see, here is as well. We can do analysis based on these figures, and we have to make conclusion, and ask the questions. For example, ask the main question from our marketing departments, or as well for logistics department. What about the logistics department? That they are working faster and can provide the services, the inventories, the goods and services quickly at the time for the customers. Or maybe this is the problem of logistics department. You see, there is a lot of reasons can be identified, but we have to find what the reason affects our inventories outstanding, and ask those people at those departments the questions, and ask them and request and require them actually to make corrections based on it, to improve their jobs actually. You see? Okay, let's move. Next, we have the ratio return on capital employed, or sometimes it comes with the main alphabet of words ROCE. You can find like this: ROCE, return on capital employed, which means. So the formula is following: you have to take your net operating profit after tax, which is net income after tax, divide on your capital employed, and multiply on 100%. So net operating profit after tax, this is same as the net income after tax. Okay, net income after tax. What is the capital employed? Here is I have given you the formula. Capital employed equal to total assets minus current liabilities. All these items you can find from the get from the balance sheet. And total assets, of course, you know the formula. This is fixed assets plus current assets, right? This we have done based on preparation of balance sheets. These two formulas. So, but right now you know the total assets minus current liabilities. It calls the capital employed. So the return on capital employed establishes the relationship between the profit and capital employed. It indicates the percentage of return on capital employed in the business. It can be used to show. So this ROCE, the return on capital employed ratio, shows the overall profitability and efficiency of the business. You see how important this ratio is. This ratio shows our overall profitability of our businesses, overall the efficiency of the business, of organization or company. Let's see the calculations. So based on the formula that I have given you previously, the results we have at the year 6 is around 34% of. That means for every $1 of capital harvester generated 34 cents in the year 6. Which in the year 7, the result comes with 39%. That means that for every $1 of capital, harvester generated 39 cents of profits. Next one, year 8, we have a 22.64. Okay, around 23%. That means for every $1 of the harvester company's capital, they have got actually 22 cents of profits. Or if the in percentage is the 22%. So you do understand that what means? In the year 6, we have got 34% of profits from our capital that we have used. In the year 7 is 39%. In the year 8 is around 23%. So let's see. From the year 6 to 7, we have some increase of our profits that we have generated from capital, right? That is a good result. But what about from the year 7 to year 8, we have a decrease. So actually, the better situation, if the higher our results, the higher our profit is, the better for the company, right? But here is we have some changes. So it affected the year number 8. What actually happened with the year number 8? Why our profit is being decreased? So main question here, right? What kind of reason, what factors made decrease of our profits, affects our profits in the year 8? We have to revise what happened in the year 8. This is, for example, in your company. For example, if it's last year, 2012, what affected in the 2012? Or have we changed our management? Have we changed our marketing strategies or business strategy, the main business strategies? Or maybe some external factors could affect our profits. So here is we can make analysis and have to find the answers for the questions. What happens with the year 8? What happened actually? What affected our profits? Let's move. Next one, the current ratio. So here is a little explanation about current ratio. The current ratio shows the short-term financial position of the business. So it shows the financial position of the company in the short terms. This ratio measures the ability of the business to pay its current liabilities. That we know based on the previous topics, right? The ideal current ratio is supposed to be 2 For what? Do you remember I have given you that we have some norms? So this is ideal ratio, how we can see that our current assets must cover our liabilities by the 2 times. Or that means the current assets must be twice the current liabilities. In the case this ratio is the less of these norms, the short-term financial position is not supposed to be very sound, and in the case it is more than 2:1, it indicates that idleness of working capital. You see? So it depends on what kind of result we have got. Let's see, based on our exercise, we can see the results on the current ratios. Okay, the formula based the current assets divided on the current liabilities, right? For the year 6, we take our current assets 170 and divide for our current liabilities, which is 112. We have got the result 1.5. You remember the ideal norm is 2, must be 2, but here is 1.5. That means for every $1 that harvester owes over this year 6, it has $1.5 within which to pay it off. And for year 7 is a 1.4, and the year 8 is a 1.9. It's almost 2, right? For almost ideal, we have ideal ratio in the year 8. That where is the harvester always over the year 8, it has $1.9 with which to pay it off. Which means the current assets is twice bigger than the liabilities. So here is, as we can see, the problem with the year 7. Can you see? It's been decreased from the year 6 to year 7. The results of the current ratio must be higher, equal or near to the 2, the norms. And at the year 8 is been around of 2. That is a good result. But we have to make analysis of what is happening in the year 7. Why is it's been so low and been decreased from the year 6? You see? So, of course, this is a year which is already the past year. That anyway, at the year 8 we have a good result, but we have to make a consideration on the year 7. If we have done some mistakes on the year 7, that would be as a lesson for our future management of our current assets and liabilities, right? So any figure must show you some picture and give you, with these results you have to prepare your answers. Of course, the answers will be generated, and as well we have to find the questions. I mean, we have to generate the question what happens in the year 7, or the results been changed, and we have to prepare the answers, right? To find the answer, actually, to find the answers. Let's see the next ratio. So this is a quick asset test ratio. Little explanation about this ratio. The quick ratio is calculated to work out the liquidity of the business. So we're going to see the liquidity of our business. This ratio measures the ability of the business to pay its current liabilities in a real way by the cash, which means the ideal quick ratio, the norm supposed to be 1:1, is a 1, and liquid assets must be equal to the current liabilities. In the case this ratio is the less the norms, it shows a very weak short-term financial position, and in the case is more than our norms 1:1, it shows a better short-term financial positions. This is how you can make conclusions. Let's see the calculations of the quick ratio. You remember the formula? You have to deduct your inventory from the current assets and divide on the current liabilities. Then you can find the quick ratio. Sometimes we can add, here is the prepaid expenses if you have so in your statements. If you don't have it, you have to just ignore it and deduct inventory only. So after calculations, we have got some results. In the year 6 is the one 1.07. So it's almost ideal norms. Have you seen? This is we have ideal results for the current ratio, for the quick asset ratio. That means for every $1 that have registered always over the year 6, it has $1, more than $1 to pay off its current assets excluding the inventories. And the for year 7 is being decreased. Have you seen it? It's 0.98 only. So it's less than the ideal norms. And the year 8 is again being increased. Our results based on the quick ratio is 1.36. So here is the same situation as in the current ratio. What have we done in the year 7 actually? What affected our results based on the quick ratio in the year 7? That means why we have no enough cash money to pay our current liabilities. Why? The question why? Maybe we see that we can find the answers. For example, if we made some purchases or we acquired some equipment by the cash, of course cash goes out, then we have this kind of situation where the quick ratio would be decreased. You see, we have no enough cash money, or it's not ideal. It's not ideal. So that means maybe you have made some purchases or some payments by the cash, and our cash goes out from the company's accounts. So we can assume this conclusion, but to make a real analysis to find the answer, we have to review all our financial statements and our reports, what is being done in the year 7. Let's see the next one. Next, I hope this is the last ratio. Okay, so and then we would finish our class. The debt collection period in the days based on the closing closing debtors. So what is the debt collection period? It's the period over which the debtors collected on average basis. That means how fast we can collect our money that we have our money from our debtors. The debtors might be customers or partners that we have made some sales on credit, for example, or some prepayments only. They make some prepayments only. So as well, it indicates the rapidity or slowness with which the money is collected from the debtors. So here is the faster we can collect our money is the better for the organizations. And we'll see the results later. The shorter the period, as I have told right now, the better is, and longer the period is, the more the chance of bad debt. That means the shorter period we can collect our debtors, our payments, actually our money. That's the best, the good for the company. If the period is longer, then that kind of debts can be called as bad debts. Then we have a lower chance to collect our money back. Although no standard period is prescribed anywhere, it depends on the nature of the industry. So we have some norms or standards for the debt collection period ratio. It depends on the industry. Based on our previous benchmark examples, we can see that the rate, what is in the industries, comes. Let's see the calculations. So the formula based on the debt collection period is the average debtors divided on the credit sales and multiply on the 365 days. As this here is asking make the calculation based on the closing debtors, we have to take the closing debtors. Sorry. But if you have just the item which called debtors in your statements, just take your debtors, okay? Because if no open and closing debtors, you just have take your debtors item. Don't worry about that if you would be confused with that. If it's asking to make a calculation based on the average debtors, you see first your financial statements. If you have some closing and opening debtors or debtors on the beginning year and on the ending of the year. So based on the formula, we have made some calculations. On the year 6, the result comes with 45.63 days. Okay, 45 days. That means in the year 6, harvester took 45 days to collect money from its debtors. 45 days, how many is around 1.5 months, right? In the year 7 is 60.33, around 61 days. You see, in the year 7, harvester took 61 days to collect its money from its debtors. It's almost 2 months getting to collect its money. And in the year 8 is 100 days. So it's almost more than 3 months has taken by the company to collect its own money from the debtors. You see, 3 months we couldn't collect our money. So can you see the situation here is what is happened? The days has been increased over the years, and this is, have you seen, increasing of days, also that the longer we can collect our money is the worse for the company, right? Previously we have seen it. So this is the bad situation actually here is. First of all, the question for sales department, right? The question is, why it takes so long time to collect our money from our debtors? The debtors can be partners or customers or suppliers. Why it takes so money? Why we sell our products on credit and and cannot collect our money, and why we cannot sell our products by the cash or to get some prepayments at least? So these main questions being addressing for sales department. They have to manage the problem with debtors, with suppliers, with the customers. I mean the manage of the payments, the time of payments, and the method of payments. How they made payments by the cash or transfers or on credit. You see, this is it. And these situations as well affect our profits, right? You remember our profit before been decreasing over the years. And this is one of the reasons could be that our profits is being decreased. You see, we give a lot of time to our partners, customers or suppliers to make a payment for our own products. That could be goods or services. This is not a good situation for the company. This is a bad situation for the company. The first things to manage our sales, to manage the conditions of the sales, to manage the conditions of the payments. Yeah, this is the main question would be addressed to the sales department. Because the sales department is managing all the sales, all the conditions based on the sales, what the price, as well the time and the method how our customers or suppliers would pay for products, right? So you say after the just simple calculations with just the figures only, what kind of conclusions we can do? what the questions arises from here and how it helps us to manage our company in a proper way, right? This is that's why I was talking previously at the beginning of the topic. That ratio analysis is very important for any kind of company, any industry, any market, any size of companies. That when we do this analysis, we can find the answers for our profitability and efficiency of the businesses. So that's all. Let's move. So this is all about the practical exercise on ratio analysis. So any questions so far based on it? I already lose my voice. Sorry. So any questions? So I would like to add tell you some information that when we do any kind of calculation, we and put the figures. We must see the picture, which means we must read between the lines of the financial statements. Must read and see the picture of our the profitability and the efficiency of the business. You see how it's important for us, for you, for all of us who's going to manage the business or be a top manager in the corporations. And I have a homework assignment, similar for this one, that you can do practice by your own based on the this ratio analysis. Let me show you. Are you here, all of you? Because you're so quiet, no questions, I can see, no charts for me. Some of leaving already the classes. Okay, thanks. So, here, the next one, the homework assignment number 9, as well based on the ratio analysis, as similar to the previously. All formulas you have already. So let's see the assignment itself. Let me explain you the homework assignment, then I will answer for your questions. So here is given to you the balance sheet in millions of one kind of company. It didn't mention, it doesn't matter what kind of company. And we have some income statement. In the balance sheet you can see we have assets, we have liabilities and equity. The assets equal to 3,300 and liabilities and equity 3,000, right? So all of items must be clear for you. Like under assets is the current assets, cash, accounts receivable, inventory. Under fixed assets, property, plant, equipment, and less depreciation. What else? Under liabilities, we have accounts payable, notes payable, some long-term debts. And under equity, we have common stock, which means the equity, the shareholders' capital. As well, we have capital surplus, some additional profits, and some retained earnings. This is all items. These are familiar for you, and if not clear, you can find the definition from my previous slides, from my previous presentations on income statement. Let's see, income statement. You have a sales. You see, if some formula asking you take net sales or take sales on credit, you just have to take this sales item. We have a cost of goods sold, we have some administrative expenses in total, and we have a depreciation expenses. As well, we have earnings or income before interest and taxes, interest expenses, taxable income, which is taxable income, same word, same meaning for income before taxes and income before taxes. Yeah. We have some taxes charges, and net income is equal to 2,304. You have some as well dividends and some addition to retained earnings. And some kind of other information for you is the number of shares outstanding, how many shares of company have in the millions. And we have some price per share. You see, it's already given to you all figures. Let's see the assignment itself. So you have to calculate the following ratios: current ratio, quick ratio, times interest earned, return on equity, debt ratio, receivables turnover, and days receivables. All these ratios, all the formulas between these ratios, you have it. Debt to equity ratio, you have it as well. Inventory turnover, and fixed asset turnover, and as well total assets turnover and return on assets. All these formulas you can get from the presentation on ratio analysis, as well as the summary of all the financial ratios would include it. And I have some additional ratios, which is a new one ratios. We haven't done some exercise like payout and retention ratios, which lighten off by the black color. The price earnings ratio, equity multiplier, market to book ratio, profit margin, EPC, and book value per share. So please make calculation, find these ratios based on the formulas. If some of you cannot do it, or you didn't find the formula, or you don't know how to make calculation, you can leave it. It's okay. So my request, please make calculations for the ratio as much as you can, and do fine. And that's all. That's all for assignment. Any questions so far based on your homework assignment? So you have a balance sheet, income statement, and the requirement, which kind of ratio you should find. If you cannot find any kind of ratios or formulas based on the ratios, then we can do it on the class on the next class, actually. No, if you leave some kind of ratios, I won't cut your marks. Of course, if you leave half of it, that depends on the mark. The best way you can do as much as you can, as you can. But most of formulas you have it in your summary list of the presentation of chapter 5, ratio analysis. All the formulas you have it already. But not based on all of these ratios we have done practical exercise in it. That's why I ask you to make at least calculation on the ratios which is highlighted by the red color. Which is the black, you can leave. You can leave if you wouldn't find. If you can do calculation for those which is in red highlight, sorry, or the black highlighted color ratios, then that's good. That's good for you and for me as well. Okay, let me see. You asked me the cash flow statement solutions. Yeah, we haven't complete yet. We haven't solved it. We can solve it on the next class. Okay? We do it. We do both. We can see the homework. We can see the solution for the assignment on ratio analysis, and as well for cash flow statement. The cash flow statement is very short one. Don't worry about that. We will complete it as well. So that's all. Please review all these topics again, because once is not enough when you are like reviewing with me on the classes. At least you need 2-3 times to review all these topics and practical exercise to understand and to remind me in you, to keep in your mind all this information. So that's all. Thanks a lot for joining the class. I hope you like this class. You like this topic, which is ratio analysis. It's very interesting. And at the next classes, based on your homework assignment, I will ask, we can do some little conversation, or as we can say, discussion. I would ask your mind. I will ask your minds about the results based on the ratios, like I have done today. I have made some analysis, talking about the reasons of the results, what kind of answer question could be raised. and we'll ask from you. Maybe not like who wants to. Okay, who wants to? I mean, who wants to and who's able to uh, make some analysis and have a speech based on it. Okay, I think that would be useful for you as well. So that's all. So thank you. So at the next class, at the next week we would have the same the same situation. Would have two class on the week, at the Thursday and the Friday, because we have to complete all our topics during these 2-3 weeks. Okay. So I will announce you on the Monday, I think so. So please be prepared. So thank you. Bye. Have a good time. Have a good weekend. Goodbye.